They operate almost completely behind the scenes, but their decisions, they shape the entire global economy. They influence your mortgage, your savings, even the price of your morning coffee. But who are they? Today, we're opening the books on the world's central banks.
It's a pretty simple question, right? But the answer is incredibly complex. You might think it's the government, maybe the big players on Wall Street. But there's another player, this massive institution with immense power that manages the very flow of money itself. So let's pull back the curtain and see who's really pulling the strings.
Yeah, we're talking about central banks. These institutions are the ultimate financial authorities. Think of them as the conductors of the entire economic orchestra. So, what is it they actually do? Okay, so a central bank isn't just another bank you see on the corner. It's the bank for the government, and it's the bank for all the other commercial banks. It basically manages a country's entire financial plumbing system, everything from the currency in your wallet to the interest rates that affect every single loan out there. And look, the scope of their power is just enormous. They aren't just setting interest rates. They're issuing the very cash you use every day, managing huge amounts of national debt, and this is absolutely crucial, acting as the lender of last resort. What does that mean? It means when a financial crisis hits and everyone is panicking, they are the firewall. They're the only ones who can step in to prevent a total system collapse. So, how do they actually wield all this incredible power? Well, they have a toolkit filled with some seriously powerful instruments. We call it monetary policy, and they use these tools to either give a jolt to a sluggish economy or, hit the brakes on one that's overheating. And it really all boils down to these two basic stances. If we're in a recession, they can go expansionary. That's like hitting the gas, pumping more money into the system to get people spending and businesses investing. But if inflation is getting out of control, they pivot to a contractionary policy. They make money more expensive to borrow, which slows everything down. Now, their most famous tool is, of course, the official interest rate. Just think of it as the base cost of borrowing money for the entire economy. When the central bank changes this one rate, it creates this massive ripple effect. It influences everything from car loans and mortgages to business investments, and even the interest you earn in your savings account. But how do they physically get more money into the system? I mean, it's not like they're just firing up the printing presses, right? They use something called open market operations. The central bank essentially buys stuff like government bonds from commercial banks. This floods the bank's accounts with fresh cash, which they can then turn around and lend out to you and me. It's a really clever, indirect way to turn the money taps on or off. But what happens when interest rates are already slammed down to zero and the economy still needs a massive boost? Well, that's when they pull out the big guns, quantitative easing, or QE. Think of it as open market operations on steroids. This was the go-to tool after the 2008 financial crisis, a way to inject absolutely huge amounts of money into the system just to keep it from completely seizing up. Okay, so we've seen the toolkit, we've seen the weapons. Now let's meet the institutions that are actually wielding them. There are a few key players on the world stage whose decisions create waves across the entire global economy. First up, the powerhouse, the U.S. Federal Reserve, or as everyone calls it, the Fed. As the central bank for the world's biggest economy, the Fed's decisions don't just affect America. Oh no, they send shockwaves across the entire planet. Now, the Fed operates under what's called a dual mandate. It's just a fancy way of saying it has two main jobs: keep prices stable to control inflation, and make sure as many people as possible have jobs. And believe me, this is a huge deal because those two goals, they don't always get along. If you focus too hard on jobs, inflation can run wild, making life more expensive for everyone. But if you only focus on inflation, you might hike interest rates so high that businesses stop hiring. It's a constant, high-stakes tightrope walk. Okay, now let's hop across the Atlantic to the European Central Bank, or the ECB. This institution is totally unique because it sets monetary policy not for one country, but for the entire Eurozone. That's all the countries that use the euro. And unlike the Fed, the ECB has a single, laser-focused objective: maintaining price stability. Its primary, number one, overarching mission is to keep inflation under control, period. And here's where you can really see that fundamental difference in philosophy. The Fed is over here juggling two balls: jobs and prices. The ECB is focused on just one: prices. And this isn't just some academic detail. This difference leads to wildly different policy decisions. The ECB's single focus can make it way more aggressive in fighting inflation, sometimes even at the expense of economic growth for some of its member countries. And of course, we've got to mention another major player, the Bank of England. It kind of mirrors the Fed, actually, with a dual purpose of its own, aiming for monetary stability, which is, stable prices, and the overall financial stability of the entire UK system. So you have these incredibly powerful institutions with these different goals. But does that power go completely unchecked? I mean, are they truly the masters of the economy? Or could they actually be servants to an even greater force? Let's dig in. Enter the bond market vigilantes. It's a great name, right? It refers to the millions of traders and investors all over the world who basically act as a global jury. They're constantly betting on where the economy is headed. And if they think a central bank is getting it wrong, like, say, not taking inflation seriously enough, they will demand higher interest rates on government loans, effectively firing a warning shot and forcing the central bank's hand. And this leads to a really fascinating argument. Some people believe that because of these powerful market forces, central banks have kind of lost their true power. In this view, when a central bank finally announces a rate change, it's not actually leading the way. It's just running to catch up, simply confirming what the market was already screaming for. And that leaves us with the ultimate question, doesn't it? Who is really in charge here? Do these powerful, deliberate institutions truly steer the economic ship, or are they just reacting to the powerful, chaotic tides of the global market? It's a debate that's right at the very heart of modern finance, and one that has no easy answer.